Welcome to Day 78 of Future Business School's Daily MBA. Today, we'll explore the risk management strategy of Goldman Sachs, one of the world's leading investment banks. Risk management is a crucial aspect of any financial institution, but for a bank as influential as Goldman Sachs, managing risk effectively is a key pillar of its success. In this case study, we'll examine how Goldman Sachs navigates financial risks, handles derivatives, and responds to market volatility. Founded in 1869, Goldman Sachs is known for its global reach in investment banking, securities trading, asset management, and financial services. As a major player in the financial world, the firm faces a wide range of risks, including market risk, credit risk, operational risk, and liquidity risk. Over the years, Goldman Sachs has developed sophisticated risk management practices to mitigate potential losses and stay competitive in a rapidly changing financial landscape. Goldman Sachs' risk management strategy is renowned for its innovation and foresight. The firm not only works to protect itself from adverse market conditions, but also uses risk as an opportunity to generate profits, particularly in areas like derivatives trading. At its core, financial risk management involves identifying, measuring, and mitigating risks that could adversely impact the firm's profitability or stability. The main types of risks that Goldman Sachs focuses on include market risk. The risk of losses due to changes in market conditions, such as fluctuations in interest rates, equity prices, or currency exchange rates. Credit risk. The risk of loss arising from a borrower or counterparty failing to meet their contractual obligations. Operational risks related to internal processes, people, systems, or external events like cyber attacks or natural disasters. Liquidity risk. The risk that the firm may not be able to meet its financial obligations as they come due, or that it will not be able to liquidate assets without causing significant loss. Goldman Sachs has developed an integrated risk management framework that covers all aspects of the firm's operations. This framework enables the firm to monitor risks across its global portfolio and respond to market developments in real time. One of Goldman Sachs' strengths in risk management is its expertise in derivatives trading. Derivatives are financial instruments that derive their value from an underlying asset, such as stocks, bonds, commodities, or currencies. They are often used for hedging risks or speculating on market movements. Goldman Sachs has long been a leader in derivatives trading, using these instruments to hedge its exposure to market risks and to provide clients with tailored solutions for their own risk management needs. Types of derivatives. Goldman Sachs trades futures and forwards, contracts to buy or sell an asset at a predetermined price on a future date. These are often used to hedge against price fluctuations in commodities, currencies, and interest rates. Options. Contracts that give the holder the right, but not the obligation, to buy or sell an asset at a specific price. Options are commonly used for both hedging and speculative purposes. Swaps. Agreements to exchange cash flows or other financial assets. Interest rate swaps and currency swaps are two of the most common types, allowing firms to manage their exposure to fluctuations in interest rates or foreign exchange rates. Goldman Sachs uses derivatives both as a risk mitigation tool and a source of revenue. For example, the firm may use interest rate swaps to hedge against potential losses from rising interest rates, while also generating profits from clients seeking to hedge their own exposures. The firm's risk-adjusted return from derivatives trading is carefully monitored by its risk management committee, ensuring that the profits generated from these activities are proportionate to the level of risk involved. At Goldman Sachs, risk management is deeply embedded in the firm's culture. The company follows a three-line defense model to ensure that risks are managed comprehensively. Business units. Each division of the firm is responsible for managing the risks associated with its activities. For instance, the trading desk manages market risk while the lending desk monitors credit risk. Risk management and compliance. This second line of defense consists of the firm's dedicated risk management and compliance teams, which work independently of the business units. Their role is to provide oversight, develop risk models, and ensure adherence to regulatory requirements. Internal audit. The third line of defense is the firm's internal audit function, which provides independent assessments of the effectiveness of the risk management framework and internal controls. Goldman Sachs also places a strong emphasis on stress testing and scenario analysis. These exercises help the firm simulate extreme market conditions and evaluate how its portfolios would perform under various adverse scenarios. Stress tests are designed to assess the firm's resilience in the face of crises, such as a sharp market downturn, a liquidity crunch, or a sovereign debt default. Goldman Sachs conducts these stress tests regularly, using sophisticated models that account for multiple variables, including market volatility, interest rate changes, and geopolitical risks. The results of these tests inform the firm's capital allocation, liquidity management, and trading strategies. Responding to market volatility, the 2008 financial crisis. The 2008 financial crisis is a prime example of how Goldman Sachs navigated extreme market volatility and emerged relatively unscathed compared to many of its peers. During the crisis, many banks were heavily exposed to the collapse of the housing market and the subsequent meltdown of the mortgage-backed securities market. Goldman Sachs, however, was able to hedge its exposure to these toxic assets by taking short positions against the housing market through credit default swaps. While the firm did suffer losses, its overall risk management strategy, including these hedges, allowed it to avoid the catastrophic failures that affected other financial institutions. In the years leading up to the crisis, Goldman Sachs had recognized the risks associated with the overheated housing market and took steps to mitigate its exposure. This foresight was a result of the firm's rigorous risk assessment process and its ability to identify early warning signs of systemic risks. After the crisis, Goldman Sachs worked closely with regulators to strengthen its risk management practices and comply with new regulations such as the Dodd-Frank Act and the Volcker Rule, which impose stricter controls on proprietary trading and risk-taking activities. Risk management in the post-COVID-19 era. The COVID-19 pandemic introduced new and unprecedented risks to the financial system. As markets reacted to global lockdowns, supply chain disruptions, and economic uncertainty, Goldman Sachs once again demonstrated its ability to manage market volatility. During the pandemic, Goldman Sachs focused on maintaining liquidity and mitigating credit risk. The firm increased its liquidity reserves to ensure that it could meet its financial obligations, even in the face of market dislocation. It also closely monitored the credit quality of its counterparties and clients, adjusting its risk exposures accordingly. In addition to managing short-term risks, Goldman Sachs continues to invest in risk management technologies and data analytics. The firm uses advanced algorithms and machine learning to identify potential risks in real time, allowing for quicker responses to market changes. Key takeaways. Sophisticated risk management. Goldman Sachs's risk management strategy is built on a comprehensive framework that covers market, credit, operational, and liquidity risks. Its ability to hedge exposures using derivatives is a critical element of its success. Cultural focus on risk. The firm's risk management culture is a key differentiator, with risk considerations embedded in every aspect of its business. Stress testing, scenario analysis, and the three-line defense model ensure that risks are identified, managed, and mitigated effectively. Adapting to crises. Goldman Sachs has demonstrated its ability to navigate major financial crises, from the 2008 meltdown to the COVID-19 pandemic, by proactively managing its risk exposures and maintaining liquidity. Innovation in risk management. Goldman Sachs continues to innovate in the area of risk management using data analytics, machine learning, and advanced modeling techniques to stay ahead of potential risks in an ever-changing financial landscape. Thanks for watching Day-78 of Future Business School's Daily MBA. Be sure to like, comment, and subscribe, and join us tomorrow as we explore another fascinating business case study.